Did you recently purchase your home using a conventional loan while taking advantage of the lowest down payment available? Well, chances are you're most likely paying PMI. Now, unless you opted to roll your PMI fees into the loan, then that's a separate video. But in this video, I'm going to share with you how you can remove your PMI successfully while keeping in mind 5 things. And I'll be sharing a real life scenario on a client that has lived in their home for 2 years, was able to prove that in fact their equity was 20% in the home, however, was unsuccessful due to a couple caveats. And if you stick around to the end, I hope to be able to share with you those top 5 things to just keep in mind when applying or challenging with your servicer on how to remove that PMI. If this is your first time to the channel, welcome. My name is Candy Katz. I'm a loan consultant and I help home and business owners qualify for funds while also sharing tips about home and entrepreneurship. So if you haven't already, smash that subscribe button and stick around for some of those tips. Let's get right into it. So what is PMI? It's short for private mortgage insurance. And when people hear insurance, they think of what? Protection. And in this case, as a buyer or a borrower to the loan, you're not protecting yourself. It's the bank that's actually protecting them from you defaulting. So the monthly premium that you're paying, or let's call it however you arranged it, if you're paid some of the PMI up front and you're split paying it in the payments, either way, you're going to be contributing to a bucket of what they call, should you default, they're protected, right? It's call it petty cash. And if you were to foreclose, things of that nature, they have some cushion to fall back on, because if you're not putting 20% down on your home, they're looking at you as a high risk borrower. So PMI is what banks charge for anyone that does not pay for the PMI up front or put down to 20%. So now that we know what PMI is, let's get into some real life scenarios and then what that looks like to help you ensure that you are successful with challenging the PMI to be removed. Now, I'm going to try to use some figures based on our current market so it can resonate. And in this case, the purchase price for someone that used a conventional loan was let's call it $560,000. Okay, let's do the math together. $560,000 with 5% down roughly means that your loan balance is $532,000. All I did was take 5% of 560, which makes their down payment $28,000, and subtract it from the 560 purchase price, making their loan amount of $532. You with me? So that means that in order to prove you have 20% equity in your home, because that's the objective here, how can I prove that my LTV is 80% or below so that I can qualify for the PMI removed? That would mean that my house would need to be appraised at $670,000. How I did that math was I took the balance of $532,000 divided by $670,000 new market value. That should bring me to roughly about a 79% LTV, 79.4 to be exact. So we want to make sure we're not shortchanging anyone and they're going to say, oh, it still rounds up to 80. So let's say that's the hypothetical scenario. But keep in mind, as a new homeowner, you're going to be organically reducing your loan to value by paying down the balance, right? And assuming that your market value is organically appreciating. So it's a teeter-totter. As your balance is paid down and your market value increases, we need to still be able to prove that 20% equity within the home. So right now, let's just pause on those figures. Because what happened with this homeowner was they was able to reduce their balance down. Let's now revisit that to $510,000, right? Let's say after about 2 years paying into the house, they reduced their balance down to $510,000. And using that same scenario of the market value did organically appreciate to $670,000, that would mean that they're at a 76% LTV if they can prove that homes are selling and have recently sold for $670,000. So let's put a pin in that scenario. The 76% technically should qualify for the PMI removal. But here I have a Loan Depot letter from this client, and it outlines all of the investor eligibility requirements. So who's Fannie and Freddie? They're the institutions that basically buys back the loans that has been originated. So whatever bank, mortgage company, broker you went through, this loan is now serviced through, call it your local banks, credit unions, things like that. But Fannie and Freddie at the end of the day are the ones that sets the regulations, right? So Fannie's guidelines reads like so. If you've been in the home for less than 2 years, the loan to value is greater than 80% with substantial improvements. That's how you qualify for a PMI to be removed. Bullet point number 2 is if you've been in the home 2 to 5 years, the loan to value is greater than 75%. Okay, and I'll pause on the other two to not confuse you. We can share those other bullet points, and those apply to when you've been in the home for longer than 5 years. But in this case is you may be a person that is looking to buy a home, live in it, call it after 2 years, and reinvest into a new primary residence, right? You're taking advantage of the system, but not necessarily like you're putting the 5% down minimum. You've outgrown the house. Maybe you're looking to continue building your portfolio. I have a ton of people doing that, right? And there's nothing illegal about it. You are truly buying a home, building, living, buying, resell, and wash, rinse, repeat. You're maximizing what's allowed to you as a homeowner when taking out a conventional loan. But this PMI can get a little tricky. So because of that, this is what happened, okay? The homeowner was under the impression that those guidelines stated because if you're in the home less than 2 years, you need to be able to prove substantial improvements that has been done to the home. And when I hear substantial or anyone in that matter, I would imagine, oh, you added a pool that cost $70,000. Maybe you added a casita, right, to the backyard. That's an extra $100,000. So those are the things that would substantially increase the value. In this instance, if you've done some cosmetic touch-ups, call it garage doors, maybe you added some new flooring, all of that would not fall under the substantial. So the homeowner in this case waited for the 2-year mark, assuming that they're not able to apply for the PMI to be removed yet. So here's what happened. The homeowner moved in October of 2021. Fast forward 2 years later, they applied for the PMI to be removed after their 2-year anniversary date. And let's call it October 4th was the close date. During the process of getting the market value reassessed and sent back to the servicer, let's call it October 18th, 2 weeks after, they unfortunately did not qualify because then now they're actually in that bucket of the 2 to 5 year LTV requirement, which is less than 75%. So if you recall what I mentioned earlier, their balance based on the proven market value in their area made their LTV at 76%. So they now either have to pay down their balance out of their pocket in order to qualify for the PMI, or they wait and reapply again. And so this is the thing. It can get pricey if you don't know this, and pricey by why. So let's start going into the 5 things I want you to keep in mind. Number 1, how do we prove that your home is less than 80% LTV? There's going to be a form that is sent to you, most likely to request for a BPO, short for a broker price opinion, or an appraisal. Okay, and the difference of the two is like so. A BPO is cheaper. You don't need to be certified as an appraiser to provide a BPO. You can just be a broker, aka licensed agent, realtor. And that's simply someone that can have access to MLS to run comps. So this is something that can be created or prepared via desktop. They don't necessarily need to enter your home. There's less steps that needs to be taken. In fact, they may do a drive-by, may not even. They can just run a report, and they're sending that to the servicer. This is a third-party vendor, okay? So the difference in pricing, a broker price opinion, typically they might charge you about, call it $190. That was the options in this case. Whereas an appraisal report, that would be necessary to the scenario where you did do the substantial improvements. You want to be sure that they're taking the actual pictures to prove to the servicer that, hey, my house is in fact appreciated in value because pool was inserted, or the backyard has that casita, those things that we mentioned, right? And not to mention and on top of that, the appraisal would require someone certified. An actual certified appraiser has to come to your home. They have a license number and they're taking photos, entering your home, scheduling the appointment. So there's a more strenuous process, if you would, but it's also pricier. Those typically run about $450. So the difference between a BPO and an appraisal is price and whether licensing is required, even turnaround time. Depending on the market you're in, does it make sense to order an appraisal? Because it could be a few weeks out. And so that's the first step. That's what you're going to want to do. And so if you didn't do any substantial upgrades, I would advise you to just go to BPO route. You're saving money out of your pocket because in the event that you're not successful with challenging your market value, worst case scenario, you're at $190 versus $450. Okay. Number two is knowing those guidelines from Fannie and Freddie. When you're calling into your servicer, they're not going to share with you what I just outlined. It might be where they rattle it off and each attendant or representative may not know that. And so it was not clear in my client's situation that they were eligible to go ahead and apply within the first 2 years. Even though they didn't do anything substantial, the market organically substantially increased. And so with that said, they could have well qualified bullet point number one, where so long within the first 2 years, you can prove your LTV is at 80% or below, then the PMI would drop off. But here we are. So number three is really knowing when your loan anniversary date is. While this scenario, it might have been where the homeowner bought the home, call it August, September, but because their first payment wasn't due until the close date, which then would vary, right? You need to know those specifics because in this case, time was of the essence. They're very particular, very time sensitive. And unfortunately, if you waited too long, you missed that window. So just knowing when that 24-month period within that 2 years is important, okay? Because then you would know which tier you would fall under. Number four would be befriending a realtor client, or excuse me, your realtor partner, someone that has access to MLS. So that way you can stay apprised on the market, know where you stand with your current loan balance. You're seeing that statement every month and you're like, okay, where do I need to be in order to apply for the PMI to be removed? And so having someone send you regular reports on recent sales in your direct neighborhood would be helpful. And if you don't, using some of the services online, such as Zillow, Redfin, Realtor.com, will give you those recent sales. You're just going to have to do a little bit more legwork. But if you need a realtor contact in your market, I'm sure I can dial you in with one of my referring partners. And so when you're looking up comps, some pointers would be making sure that they're, of course, comparable to the subject property, your home. Now, if you're comparing square footage that is bigger and newer and more upgraded, that most likely will not be used in the comps, right? And things that you want to keep in mind is last 6 months and also within about a mile from your home. Now, if you can't find recent sales using those parameters, then stretch it out to last 12 months and try not to go more than a mile or outside of your radius. And then lastly is number 5 is, again, this is if you needed to refinance your home to remove the PMI. You don't necessarily need to go through the whole refinance process. You're technically just going through the servicer to ask for the PMI to be removed because there's talks that it will automatically fall off or you need to refinance your home. That's not necessary because you're going to be paying title fees, closing costs, things like that again. This is simply going through your servicer. So making sure that you're clear on that so you're saving money. So let's kind of recap. Number 1, knowing the difference between paying for a BPO or an appraisal. 2 is knowing what those guidelines that are assigned with Fannie and Freddie guidelines. So the other 2 bullet points I want to share with you is if you've been in the home 5+ years, the loan to value is greater than 80%. See how that can be tricky? I mean, I've been in this home for 5 years, but you're still requiring for my LTV to be higher than 80? That makes no sense. It's just the wording for someone that may not be as savvy can be tricky. And then their last bullet point would be for Fannie Mae is investment property 2 to 4 units. The loan to value is greater than 70%. Now, if your loan was bought back by Freddie Mac, that the investment property would need to be greater than 65%. So again, just being clear on that, I'll try to screenshot this and share it within the video so that you can see. And yeah, that's pretty the nuts and bolts. You know, your PMI, it can range. I've seen it sometimes in the hundreds, and it can go up higher to a few hundred. So if you're adding that on top of HOA, maybe you have SID lids, whatever those additional fees, it's nice to be able to say, look, I've been a loyal paying customer, client. I want to be able to now qualify to have that removed, because you could be taking that amount and paying down more of your principal, right? But this was a long one, guys. I think it was a solid. I've been meaning to do this video, and I'm so glad I got all the nuts and bolts to you. Please share your success stories and any questions you have as you are going through this journey of removing that PMI. I'm excited to continue to be a resource to this community. Thank you so much for being so loyal. If you stay to the end, and if you haven't already, make sure you subscribe and share this video to someone that you know can help in the same scenario. Thanks so much, and see you guys on the next video.